Okay, well, we're at the top of the hour. Why don't we get started? Hello, I'm Mark Noble, Executive Vice President of ETF Strategy at Horizons ETFs, and welcome to our latest webinar on ways to park cash. This webinar will be focused on cash alternatives and low-risk income ETF strategies to use in a portfolio. A large focus of today's webinar will be on T-bill ETFs, as we recently launched two ultra short-term T-bill ETFs last week, which trade under the ticker symbols CBIL and UBIL.U. And with a consistent march forward on interest rates, cash alternatives have become a real growth asset class with tens of billions of inflows in Canada and quite a bit more even in the US. With us today to go over this increasingly important asset class for investors is Alec Riley, our Associate Portfolio Manager and ETF Product Specialist. Alec has spearheaded the development of our T-bill ETFs, and he'll be providing us context on where they fit in a portfolio and how they can potentially be used to both improve the risk dynamics of a fixed income allocation of a portfolio, as well as actually right now with high interest rates, a very attractive potential cash alternative. Alec, thanks for joining us.
Thank you for having me.
We will have a Q&A at the end of the webinar, but our goal is to really get all the content completed in less than 20 minutes. We're focusing on a fairly tight product segment here. So please stay on till the end if you have any questions, and we'll do our best to stay on and provide whatever answers we can. Also, you'll notice that a lot of what we talk about today and materials are on the right-hand navigation of the webinar, and all of those materials can be accessed anytime you like. Alec, if you just want to move to the agenda there, and we'll quickly go through that. So our agenda is fairly simple. We're going to talk very quickly about cash and cash as an asset class and how it's become so popular over the last 12 months. Then we're going to talk about the product structure of our two ETFs that we launched, the Horizons 0 to 3 month T-bill ETF and the Horizons 0 to 3 month US T-bill ETF. We'll also talk about our popular Horizons high interest savings ETF, because obviously there are some differences between that product and what we've just launched, and there's benefits and different considerations for all those. And then we'll talk about where all this likely fits in the cash risk spectrum of a portfolio. So I think a lot of people consider cash, particularly up until recently, as really a form of capitulation. We viewed cash as an exit from the market, not as a performance asset class. It's where you went when things were going really poorly. But actually in 2022, if you had owned cash, and here we're using our example of our Horizons high interest savings ETF, you were actually generating strong positive returns relative to the performance of most other asset classes. So what you can see here is in 2022, most asset classes, Canadian equities, treasuries, REITs, even Bitcoin obviously, had negative returns and fairly sizable negative returns, where you really were looking at three asset classes, crude oil, gold, and cash, as positive generators of return for your portfolio. And I think this has really been one of the reasons, beyond just the rising interest rates, that has brought a lot of investors to this category in a huge way. And Alec, I'm hoping you can provide a little bit more context of what do you think the reason for this is?
Yeah, so I think it's a couple things, Mark. And the first thing that we want to highlight, just to your point, is how large the inflows have been into this product lineup. What we've seen has been, frankly, in many ways, unprecedented, both in Canada and actually increasingly in the US too. So these ETFs, they started relatively recently, and really they've grown at a very fast pace, well over $10 billion in Canada in the last year in the HISA ETFs, and actually similar numbers even higher in the US. And what you're looking at here on this chart is the Canadian ultra short term and HISA ETFs combined AUM on the left side, and then the right side shows the flows. And the AUM now is well over $20 billion. So Canadian investors have really taken an interest in these ETFs. And I think the ETFs that we're going to talk about today, they fit into this well, and it's a good complement. So to your point about like what's driving this, I would say it really has to do with the level of inversion in the yield curve has created some really unique characteristics in fixed income. Particularly what this chart shows is the yield on the left side, and then on the bottom here is the standard deviation. And we use standard deviation of returns because we wanted to be able to highlight both interest rate risk by looking at longer term government offerings, and then also looking at, credit as well. And I think what's fascinating and why these ETFs have seen such an interest both in Canada and the US is because from a risk reward perspective, like if you look here at the 1 to 3 month US T-bill index, what you have here is yields over 4%. And really, like, the only place you're getting a better yield than that is in high yield, and maybe a little bit in corporates, but it's a marginal increase for quite a bit more risk by historical standards.
And I think what you're showing here is a little bit of a risk trap in that, you're getting the same return, but the risk variance across all of these fixed income asset classes is quite a bit different, as that standard deviation chart shows. But I think what we've seen is that as you can see with the 1 to 3 month US T-bills, I mean, these are probably providing the most attractive risk reward profile on this fixed income spectrum, which is probably why, no surprise, we've been very keen to launch products that give you exposure to this risk reward profile.
For sure.
And that would be the Treasury bill ETFs that you've been developing on our behalf, Alec, and I'm hoping you can go through those right now.
Yeah, so I think before we get into the products, like, T-bills are something that have been neglected, I would say, for quite a while, because for the longest time, they haven't offered any yield. But due to the kind of accelerating hiking cycle that we've seen, now there is a yield, as we've talked about. And so really, like, we're almost learning about T-bills again for the first time. And I think just we have a lot of materials that are in the side that you can look at if you want to get a more in-depth explainer. But the main points to hit are that T-bills are issued by their respective federal governments for their financing needs. And unlike most other fixed income instruments, they're issued at a discount to face value. And then as they mature, they're pulled to par and you receive that face value. And the last kind of piece in terms of like T-bill mechanics is that neither the Canadian or US government has ever defaulted on their debt obligations. And so these really are seen as among the safest underlying investments that you can make from a portfolio perspective. And I think the last piece to highlight is that if you look at T-bill rates, and these two charts here show the 3 month T-bill rate for Canada and the 3 month T-bill rate for the US, as well as their respective central bank policy rates. And the T-bill rate tends to increase and fall with the prevailing interest rate environment. And that makes intuitive sense. And I think that's part of the reason why, when you look at the rapid increase in interest rates, why we thought there was a great opportunity to launch these two ETFs.
Well, the risk reward profile, right, is very interesting here, because we typically use the 3 month T-bill as how we calculate the risk-free rate. Obviously, there's no risk-free return of investing, but what you've highlighted there is you've gotten compensated now for an area of the market which probably offers the lowest risk profile for investors.
For sure. And I think that's why these products are well positioned right now. And just quickly going through some of the product details, and then we'll have a more the remaining part of the discussion. The two ETFs are, as you mentioned earlier, CBIL, the Horizon 0 to 3 month T-bill ETF. And you can see the details on the website and then also on this slide. And the thing to keep in mind about both products, the Canadian version and the US version, is that they generally invest in T-bills with maturities that are generally less than 3 months. And from in terms of the management fee, you're looking at basically 10 basis points for the Canadian version and 12 basis points on the US version. And I want to note as well that the US version trades in US dollars, which is an important consideration. And we've also highlighted, the yield of both of these ETFs, which, we'll talk about as we go forward.
And of course, another ETF that we offer in this kind of cash spectrum, but this isn't based on policy rates with the T-bills, is our Horizons High Interest Savings ETF, which is currently yielding 4.95% on a gross basis, and then minus the 10 basis points, so sort of 4.85 yield. But the thing that we need to highlight, if you want to just move to the next slide, Alec, is that these HISA ETFs, we didn't launch these T-bill ETFs with the idea of trying to replace HISA ETFs. What we're trying to highlight today is that there's a little bit of a different risk spectrum in terms of how these work. And with the HISA ETFs, a lot of investors are probably not aware of the fact that the yields set by the HISA ETFs are set by the large Canadian banks that are deposited with, and they set the rates based on a plus or minus margin versus the overnight rate. So certainly they offer, similar to the T-bill ETFs, the ability to rise as policy rates go up or down, or go up, obviously in the case of them increasing. However, they are still set by the banks. And so that means that there could be a divergence that occurs between what are offered by the banks and what are potentially offered by the policy rates on the T-bills. And I think you've highlighted this in the next slide, Alec, where we can already see, some of these slight differences.
For sure, right? So there's a lot of similarities between these different categories in that they're all considered relatively safe investments, but there are some subtle differences, as you've indicated. So first, to start with the similarities, if you look at both the HISA ETFs and the T-bill ETFs, both are ETFs, which means they can be bought and sold at any point during a trading day. So they're extremely liquid. And also, as you mentioned earlier, the yields are expected to rise and fall with whatever that prevailing interest rate environment is. You contrast that against, say, a GIC, which typically carries a fixed term. And of course, your interest rate is set at the beginning of that term, which is in stark contrast to the T-bill and HISA ETFs. There's also some differences between the T-bill and HISA ETFs that I think matter as well that you've highlighted. And the first is, in both the GICs and HISA ETFs, the underlying investment is with Schedule I banks. Now, that's not the government. The T-bill ETFs, on the other hand, the underlying constituents, that's government T-bills. So they're backed by the full faith and credit of the respective government. And that means that in the case of T-bill ETFs, CDIC insurance isn't really something that is applicable because the respective issuer is the government. And that I think yeah, exactly. So one of the things that I think has been an obstacle in some cases for the HISA ETFs is that they're not CDIC insured. But I really think that these T-bill ETFs, it's the highest quality, and when you're looking at on a relative basis, even though the yield might be a little bit lower than say a HISA ETF on T-bill ETFs, I think it would probably be quite surprising to many investors just the divergence between GIC rates and where interest rates are right now.
It's actually astounding that you set up this slide here, Alec, because you mentioned the yield curve at the start of the presentation. And just for those of you not familiar, the yield curve is talking about where yields are on a multi-year period. So historically, longer dated yields, that is 5 years, 10 years, would have a higher yield than shorter rates. And as we mentioned earlier, the cash ETFs like cash or HISA ETFs are based on the rate being offered by the banks. And we are seeing already that, at least on the GIC side, that they're already starting to bring down the rates on the longer dated GICs because of this yield curve inversion, which suggests, again, that there can be a difference between the policy rates that are offered by T-bills and what are offered by the banks.
For sure. And I think like that highlights, just if I'll go back to the previous slide for 1 minute, that really there's only a few GICs that actually have a higher yield than what you're getting on T-bills. And I think that really accentuates the point that you just made. So the big question now is like, why should you choose T-bills and why should you choose T-bill ETFs? And really there's a couple reasons that we've highlighted. And the first and most important one by far is safety. And these are the underlying holdings backed by their respective governments. These are among the safest investments you can make. And so for risk-averse investors, this is really a good place for them to feel comfortable parking cash because they don't need to worry necessarily about the underlying credit quality or be subject to any kind of credit risks that you might see in other kind of savings vehicles. And then, I would also say there's another kind of use case here, which is not necessarily just as an alternative savings vehicle, which is what you might associate with a HISA ETF or a GIC or even an internal savings account, and that these are ultimately fixed income ETFs at the end of the day. And so what that means is that for an asset allocator or a discretionary PM, like what these ETFs provide is opportunity. And what I mean by that is you have the opportunity to take risk in other areas of your portfolio, knowing that you have an allocation to an asset class that historically has been seen as being, risk off. And that is really useful because you can be more tactical and you can leverage your expertise and your edge where you have one without needing necessarily to be constrained by certain risk elsewhere. And the reason why you can do that is because of these competitive rates. So you can feel comfortable sitting in this cash alternative, and you can use that in like a barbell or even in an extreme barbell to pick up yield or return elsewhere and really leverage your own tactical views.
Amazing, Alec. And as you highlighted, it just goes back to those early slides, just suggesting that you're now getting a yield, you're being compensated to be conservative, and that's something that hasn't existed before. And now, as we mentioned, there's actual performance benefits to this. With that, if you just want to push to the next slide and through our legal and our performance, we are going to open up to questions. I have a question about futures, that's why I mentioned that. But we did meet our time threshold there, but we probably have another 4 or 5 minutes where we can get into questions. So I hope there'll be a few more. This is an interesting one, and I didn't think about this. But do these ETFs, Alec, do they hold T-bill futures, or do they actually hold the underlying T-bills? And maybe you can explain a little bit the process of holding those.
For sure. So it's a good question. In the case of these ETFs, and what's nice is our holdings are available on the website every day. So you can always transparently see what the ETFs are holding. We hold between 6 and 8 T-bills at any given time. And really, like the analogy that I like to use is that it's almost like an escalator. Right. So at the top of the escalator, you have your longer dated T-bills, which are generally less than 3 months. And then obviously, as you go down the escalator, you're going to have these T-bills which are nearing maturity. And that kind of balance means that over time, and with subscriptions to the ETF, and then also as you have maturing T-bills, you're always able to replenish, if you will, the term to maturity on those on the portfolio. So really the goal here is that we hold these underlying T-bills, as I said, between 6 and 8, and we're trying to maintain a target duration within a band. And the benefit of that, as I said, is you get to maintain a balance between basically ensuring that your reinvestment risk and your pricing risk are in balance. And that's beneficial, because if you were to buy a single T-bill as an example, and interest rates move, let's say they move up, then you're waiting before you can reinvest at higher rates. Whereas, sticking with this escalator analogy, you're always getting the opportunity to reinvest depending on the changing interest rate environment. So it's always physical T-bills. Exactly.
Capturing that rate movement. Someone would like a little bit more of an explanation of, in your opinion, how these would compare to the HISA ETFs. I guess just a little bit of when or where, we obviously can't offer advice, but when or where these would be used relative to a HISA ETFs. Maybe you could just quickly touch on pros and cons, although I think there's probably mainly pros with both of them.
Yeah, and the reason for launching these products wasn't because we thought that there was something wrong with HISA ETFs, right? Like HISA ETFs have been an extraordinary successful ETF, and our cash ETF, as you highlighted earlier, Mark, has been very successful as well. And the HISA ETF, the benefit of that is that it's an alternative savings vehicle that's really liquid. The T-bill ETFs, I think it's too easy to fall into trying to maximize yield. And the HISA ETFs are certainly doing that, but the T-bill ETFs, the primary function is really safety. And when you think about it in that way, you understand that the point of that is so you can feel comfortable taking risk elsewhere. And if your concern is that the yield on the T-bill ETF, for example, is too low, there are lots of other opportunities where you can increase the yield on a portfolio level without increasing your risk.
That's a great answer. Will the distribution be treated as dividend or interest income? Maybe you can talk a little bit about that, because I think, as you mentioned with T-bills, they're a little bit different because you're not actually being paid a coupon, but I believe the tax treatment is still income.
The tax treatment is still interest income.
Yes. Are these ETFs similar when it comes to taxes for a Canadian when compared to BIL in the US? Great question. I can actually just answer that one quickly. I mean, it would be the same because it's interest income, as Alex just said. So it would be foreign interest income. They're both taxed at your highest marginal tax rate, is our understanding, whether it was BIL or CBIL, in terms of the taxation considerations on that part of things. In terms of UBIL.U versus DLR, DLR would be our US dollar ETF, and I know we have a lot of investors in that. How would UBIL.U be different than DLR?
So the difference really there is that DLR, while under the current interest rate environment, it's benefited from increasing interest rates. The purpose of DLR is as a currency bet first and foremost. And so DLR trades in both Canadian and US dollars, and it can be used as a currency conversion tool, whereas UBIL is really meant as an asset class or as an alternative savings vehicle and not as a trading tool.
Right. Makes perfect sense. I think we have one final question here, and it was just be in terms of how these would be treated from a trading perspective. Would we expect a bid-ask spread? And what would that sort of be? And I believe because treasuries are fairly liquid security, that really shouldn't be a problematic consideration.
Yeah, it's not under normal market conditions, we would not expect or anticipate the spread to be wide, right? So I think if it's any comfort right now, if you look at both ETFs, they're trading at 1 cent wide. We would generally anticipate that the spread will stay relatively tight. So I think investors can feel comfortable knowing that. And again, that has to do with, as you said, the low spread on the underlying investments themselves. So if you invest in really liquid securities, you're going to have a very liquid ETF, and that's the same case here.
Then finally, we just have a number of questions about will we be provided with a copy of the presentation. I believe that is potential. Otherwise, we do have contact details from that question, so we will try to reach out afterwards with the presentation if you're an advisor or an investor. With that, I believe we're finally done with questions here. Oh, we have one last question. And it's important we highlight this one. Would we hedge against USD CAD rate on UBIL.U? I think the answer to that is no, because we don't actually offer UBIL.U in Canadian dollars. So there's no hedge version of that. So UBIL.U would be purchased in US dollars. And it would be ideally then for a US dollar account. There's no UBIL that can be purchased in CAD, or you could purchase, sorry, I should take that step back. You could purchase that in CAD, but then you would take the currency conversion. But that ETF itself is denominated in US dollars, which means there is no hedging occurring in these products. With that, we're at the 20-minute mark, so I want to thank Alec. Awesome, great job, and I really appreciate you providing us the insight on development and context of these products. And thank you to all the listeners. We look forward to doing more of these webinars, kind of talking about where some of these ETF categories fit, but certainly cash is a real asset class now. It's delivering returns that we haven't seen in probably half a generation, and that's driven this interest. So hopefully today's presentation has given you a little bit more insight on where things fit on the cash spectrum. Thank you again.